Over long periods of time, daily price direction for any asset is distributed roughly 50-50 up or down. Okay, that's a tasty trade. We're there. Does the level of volatility in that underlying change that 50-50 distribution into being skewed one direction or the other? Mr. Batista?
Mm-hmm.
Does the level of volatility in an underlying skew the 50-50? Because let's just say in gold, for example, you have a lot of upside call skew.
Yes.
Or in, some stock like Nvidia, there's upside call skew.
Right.
Does that skew the directional distribution?
No, over time, no.
Okay. Tony says no.
In my opinion.
We researched SPY, IWM, TLT, GLD, and we did it from 2015 to present. That's over 8 years worth of data. We recorded the IVR for each asset over that period, over that time period. We compared the following stats for the full period: IVR below 30, IVR above 30. We looked at the distribution of up and down days, the size of the average up day and down day, and the average size of up days and down days that exceed the one standard deviation threshold. Okay? And that one standard deviation threshold measures the size of the directional skew in each asset. When looking at all IVR environments, everything was symmetrical, both up and down, just like Tony said. The proportion, the average size, the number of big moves was the same to the upside as the downside in all IV environments and since 2015. Okay, Mr. Anton, let's talk about this. What do these numbers mean?
So when we talk about a distribution of stuff, right? S&Ps, gold, whatever, you pick your asset.
Mm-hmm.
We know on any given day, we say, okay, it's about 50-50. In equities, it's kind of 53-47, but everything else is 50-50, which this shows that that's true. Overall, for all period, like over long periods of time, it's 50-50. The number of the average size of each up and down day is about the same, like in terms of up day versus down day for each asset. And the amount of up days that are larger than the one standard deviation move is the same as the number of down days. So in other words, the tail is roughly symmetrical as well over long periods of time. Okay, but we know, so this is kind of what we know, right? But the thing is, we also know that when we look at something like the SPYs or gold, we tend to see some skew. In SPY, we see it to the put side. In gold, we see it to the call side. In TLT, we don't see any skew. I put these underlying specifically intentionally because we have one asset with call skew, gold, one asset with no skew, TLT, and two assets with put skew, okay? And the thing is, if we look at over long periods of time, we don't really know where the skew comes from because it's all symmetrical. So when we separate by the volatility environments, we're going to be able to see why SPY and IWM have put skew, why gold has call skew, and why TLT has no skew.
It's really amazing that when you look at these, the number of up days to down days is so right in line over time. When IVR is low, equities become significantly skewed to the upside in proportion and the number of big up days. For bonds and gold, the symmetry still remains intact. So let's take a look here. These are IVR. This is since 2015, and only IVR lower than 30.
Mm-hmm.
Okay, so let's take a look here and see. Yeah, there's I mean, it's definitely changes all the metrics.
Yeah, sure does.
Yeah, and the reason, so I bring the low IVR is important to look at. It's not as important as the high IVR, but
Yeah.
I wanted to bring up the low IVR first because it shows you that even in equities where all the skew is to the put side, when IVR is low, it's no longer 50-50 or 53-47. It's basically 60-40. Like that's the environment that we live in most of the time is not a 50-50. It's a 60-40.
But that's also, remember you're pulling the data from a very strong bull market the last 8 years.
Granted, 100%, but this is the data we got to compare it, of course.
No,
But
you can only deal with what you can only deal with what's there. Right, exactly.
exactly
But I
now,
am pointing out that it has been a bull market.
right now, the reason why the skew in the low IVR environments doesn't matter as much is because if you look at that middle column, the average size of the up and down move, those are very small relative to when IVR is high, right? When IVR is high, you can see 1%, 2% moves pretty frequently. But when IVR is low, the average up and down moves are like half of 1%, maybe 0.7% at most. And that's why when you look at the options, you're never going to see call skew. Well, let me rephrase. You're very rarely going to see call skew in equities, even though you have a lot of upside momentum in this environment. It's because the average moves are small.
Yeah.
Right. So the skew doesn't come from that because those are just like if you have a 0.5% move to the upside and then another 0.5% and then another 0.5%, you're still going in a relatively slow direction compared to an IVR side. So skew doesn't come from this, but I'm just showing you when IVR is less than 30 that this is what it looks like. Okay.
When IVR rises, equities realize their downside skew in the proportion of down days observed and the number of big down days. Bonds stay symmetrical as expected, and gold sees its upside skew realized. So yes, everything flip-flops the other way when IVR is over 30 since 2015. That's a pretty big flip too, because it's not like we've had some pretty extended periods of IVR over 30 and we're still in a bull market.
Right. And the really cool part is now in equities, first of all, like in SPY, it's no longer so in high IVR, it's 60-40 to the downside, right? And that's kind of where it's such a drastic shift. That's why trading premium when IVR is low versus high, it's such a big difference because it's such a different environment. Now, this is why the skew comes from this slide. And notice TLT, number of updates to down days, which are big updates because they're the number that exceed one standard deviation. These are like the big moves. It's 1-to-1 in TLT. And if you notice in TLT, there's almost never any skew because when you have those big volatility moves, it's equally proportioned to the up and the downside. The number of updates and down days is 50-50 in TLT as well. So that's why TLT has no skew, because when IVR goes up, there's no skew to either side in the realized price action. So there's no skew in the options markets. Now, if you go to SPY, it's obviously different. IWM, you get for every one big update, you get 70% more big down days in SPY. In IWM, you get 30% more big down days. And notice the average size of those up and down moves is 3 times larger than in low IV environments for SPY and 2 times larger than IWM.
Yeah.
That's why the skew comes from this slide, because these are the moves that really can move the market, okay? In high IVR, that's when the market moves happen. So whatever the skew is on this slide, that's where the option skew comes. And if you notice in gold, again, 1.2 to 1.
Yeah, that's a really interesting way of presenting it, Anton, because I don't think we've ever presented it like this, and I like it. You know, just talking about the average size of the up and down moves, and that's where the skew comes from. Because we talk about velocity, but we've never like put some context around the word velocity, and that's what this does.
Exactly. And again, so when you trade gold, right, and you see IVR go higher, well, all of a sudden you get 56.44. That's a huge departure from 51.49 on the last slide. And when you have 20% more big up days and down days in high IVR, well, that's why your call skew gets realized in high IVR, because that's where all the risk is. So if you notice, you look at all these underlines, the skew will be to the side that the biggest number of asymmetry happens.
Yeah, that's interesting. That's really good. When you average all environments, every metric is symmetrical and distributed equally to the upside and the downside. When you separate by high and low implied volatility rank, you see equities and gold lose their symmetry in favor of skew while bonds remain symmetrical. Option skew will be determined by the skew in the realized price data when IVR is high.
Yeah. So it's basically saying when volatility is higher, whatever you tend to see happen, that's what the options will be priced at all the time. So that's why SPY and IWM have put skew all the time. Gold has call skew all the time. Bonds never have skew because when IVR is high, that's what happens, and that's what the options are based off of.
Nice. That is good stuff.